Good morning and welcome to another Subject to Finance on Monday the 18th of March. I haven't been great on these this year, so I've got a bit to catch up on today because there's been quite a bit going on and I've missed a couple. So I'm going to start with just sort of setting the scene on a few things. So at the last OCR update that we had a couple of weeks back, there was a no change from the Reserve Bank in terms of the OCR setting. So nothing much to talk about in terms of the actual OCR rate itself, but in that commentary that came through, what it sort of suggested is that those things that they're watching are improving. So inflationary issues around both imported and domestic inflation, and other bits and pieces that they monitor. And in fact, it had quite a strong sort of tone of there being a move to downward pressure on interest rates. So that's the first thing I sort of wanted to cover off. That downward pressure piece means that we can expect to start to see our local banks moving back the other way in terms of interest rates, and we have been seeing that for a little while now. So they have access to wholesale funding at a global level at a lower cost potentially because of that move globally and a slight shift to rates moving down. So what does all that mean? Well, banks are showing already reductions in rates, but mainly in the short term periods, so 6 to 18 month range if you like. And those shifts are mainly at the public rate level. So what we're sort of seeing is that if you look at the publicly available rates from all the banks, they've shifted that short end of their rate metrics down. And when I say they've shifted it by sort of around about 10 basis points on average, actually at the negotiated level that brokers such as Tella and others have access to when they deal with third-party banking is a little unchanged. So although the public rates have come back, we're not seeing that coming back in terms of the negotiated rates so much. So not too much change there. You know, your sort of best rate in that sort of 6 to 12 month sort of period is around about the 689 still. So nothing really major has changed from that perspective. But what it's sort of signalling is that they are looking at moving rates back both on the mortgage side and on the term deposit side. Longer term rates, 2 to 5 years, nothing much happening at all. So yeah, it'll be interesting. That's sort of more of a signal that longer term they feel that rates are coming back, and I'd like to see more of that to be comfortable that we are in a downward cycle, if you like, in terms of the interest rate cycle. But at the moment there's not much change going on there. What are we hearing from the industry? And when I say the industry, I mean both on the sales side in terms of housing, but also builders and also banks. So I thought I'd just talk to a few things that we've been seeing and hearing over the last week. From what we hear, we're at a real high level of houses on the market. So we're back to levels that were last seen sort of around 2011. And there's talk, you know, when I talk to some of the property banking areas, the corporate banking areas, there's talk that there is still more stock to come. So there's still big projects out there that are being wrapped up at the moment, which will eventuate with more housing on the market in the near term. So there's plenty of availability of stock, particularly at that lower end of the market where the government was looking to solve a problem around that sort of entry level and that state housing piece. So that, you know, if you're a buyer at the moment in that space, that's you've got more choice than ever, really. And what we hear from some of the agents that we've been talking to is that open home viewings are still relatively low. So the walk-ins that are coming into those on the Saturday morning and the Sunday morning are not as strong as they'd like. So again, and that seems to be across the board. So again, availability's there, competition isn't. So again, buyer's market. Auction clearance is improving in some areas, but not across the board. So that sort of points to there being some key areas across the country, and we've all heard about them, particularly areas in Auckland even, but largely the areas like the Queenstowns that are really still almost not feeling any change over this whole period. They've just continued to have that sort of sustainable growth and solid sort of audience looking for homes. So I'm going to switch over to the banks. And the banks are very open. I mean, I don't think I've seen a more willing marketplace in a long time. They're all looking at their product, they're all looking at their terms, and they really want to ensure that their balance sheets don't shrink too much, because what we've had over the last few years is what you get in a down cycle where people are really debt averse. They're not doing the little bits and pieces of top up, they're not buying the next home, they're just hanging in there and making sure they get debt down. And for a bank, that means that their overall balance sheet, the home loans that are sitting on it, have been shrinking. And I think I've talked about the last 12 months versus prior periods in terms of what new loans have been written in our market. And roughly, and I won't get too much into the periods that we're talking about, but roughly in the last 12 months we're at about 60 billion new dollars of home loan in the market, versus prior years where we were sort of up even into the 90s. So we've seen that new business shrinking, but we've also seen the loans sitting on those bank balance sheets just getting paid down because people aren't in a position to actually trade up or do the next thing or spend a lot on a kitchen. Just on the banks, they're certainly open to higher LVR than they have been in the past. We're back to first home buyers being able to buy at 95%, where we were limited to often 95% being off plan. At the moment, you can get, if you pick up a new townhouse that's just recently been finished, first buyer if you like, you'll be able to pick that up at 95% with the right bank, subject to you having the right income. So there's real appetite to lend there. Other things that we're sort of seeing is more appetite to self-employed income and other types of income. And some examples of this, New Zealanders working overseas, they often earning good money, they want to buy a house while they're overseas that they can come back to, or as an investment, so that they've got that when they do return to New Zealand at some point in the future. In the past, it's been really hard for us to use their offshore income, and that's certainly become easier just in recent months. So more appetite to use of offshore income, even if it's self-employed offshore income. More appetite to other types of income. And I'll give you an example of other types of income, because this is a really interesting one, I think. BNZ have recently come out and said that they'll accept income that social media influencers earn, and that's income coming from the likes of the YouTubes and the Instagrams and the TikToks, where they can show a sustainable level of income over a 12-month period. So we're starting to see those types of what would have once been deemed hard incomes to deal with becoming acceptable. Albeit we have to go and really vet them and make sure that we can see that they're sustainable. The banks are in a position now to actually look at those types of incomes a bit more favourably. Really what's happened is the heat's come out of the market. They don't want to lose that balance sheet, so they're having to work harder, and that means just really looking into those loans a bit more, doing a bit more work on them to get themselves comfortable, to get them across the line. What does that mean overall? It really is a buyer's market at the moment, so if you can afford to and you're wanting to, it just doesn't get any better than this, really. The hard thing is that most of us are sitting in a environment where cost of living's gone up, and we either can't afford to do these things or we're just very cautious. So, that's the flip side of the coin. So that's me in terms of a bit of a quick update on the last few weeks, and I'd like to, as I always say, I'd like to sort of see what you're hearing and feeling in the comments. That would be really great, and we'll talk to you again next week.